Good morning. My name is Uday Turaga and I'm with ADI Analytics. Welcome to our weekly webinar series. We're going to talk about petrochemical and plastics markets today and how they are coping in the perfect storm. For those of you who don't know us, briefly, ADI is a boutique consulting firm. We focus on oil and gas, energy, and chemical markets. Within these markets, we work across the value chain. We work with a wide range of clients. We supported over 150 clients over the last 11 years. And some of them are listed here. As you can see, we do a lot of work with the larger oil and gas and chemical companies, but also a number of suppliers and equipment providers, as well as investors and early stage companies. About 2.5 years back, we acquired Chemical Market Resources, which is a 30-year-old company focused on serving the chemical, petrochemical, plastics, and polymer markets. Since the acquisition of CMR, this has significantly broadened and expanded our capabilities across the entire hydrocarbon value chain. And some of the research that you'll see today is based on some of the output from the CMR team at ADI. Clearly these are interesting times that we live in, and clearly there's a number of needs. ADI can support our clients and your business in a number of ways. We can help with market research and technology assessments, strategic planning, and help with corporate strategy, pricing, cost, and economic analyses, support around transactions and M&A, and a number of other services that are also listed here. Happy to get into some of these details if this is of interest to you. We've been very active in general in the chemical, petrochemical, and plastics markets. Some of our most recent projects are here. Recently helped an independent operator with assessing the feasibility of a grassroots PDH project, looking at the entire value chain. Helped another Asian chemical conglomerate with an assessment of the polypropylene market, in particular with a deep dive into the specialty grades and products. We also do a lot of work with relatively smaller players within the chemical industry. Recently, we looked at a small chemical distributor and helped them develop an expansion strategy on the US Gulf Coast in response to some competitive developments. We just wrapped this piece of work up, helping a Middle Eastern major with a market strategy focused on polyethylene products and looking at a broad range of polyethylene products, including traditional polyethylene, as well as some of the newer variants, including polyolefin elastomers. And then finally, a few months, maybe 6 months back, we helped specialty chemical manufacturers. We have conducted due diligence on a specialty chemical manufacturer for private equity investors. So pretty broad range of projects that we have been involved with. In addition to the classic consulting work, we also publish a number of multi-client studies and reports. In particular, Chemical Market Resources, the company that we acquired, has been publishing these multi-client reports for a long period of time. If you go to our website, you can see a little bit more. And the full listing of multi-client reports that are available. Some of them are listed here. A couple of reports that we just published include a global assessment of polypropylene, as well as a global assessment of EPR and EPDM markets. For those of you who have been tracking some of our work, we've published a lot in general on oil and gas in the perfect storm, coming from the oil price crash and COVID-19. If you'd be interested in tracking some of the newer research, please take a look at our website and you can read a little bit more. And of course, we have an in-depth study that goes into the different segments within the oil and gas industry and the hydrocarbon enterprise. doing a deep dive in petrochemical markets as part of our new report that is designed to help clients navigate this perfect storm. If there's interest, happy to discuss some of this. So with that, let's get into the topic of the webinar today. We're going to talk about petrochemical and plastics markets. I'm joined today with a couple of my colleagues. Panusvi Trivedi is an analyst with ADI. I'm also joined by Utkarsh Gupta, who's also an analyst with ADI. Both Panusvi and Utkarsh have worked on some projects in the chemical space recently, fairly large projects, and bring unique insights and expertise. And we'll get into a short discussion with them at the end of this, at the end of our presentation. So clearly, in very uncertain times, we've seen dramatic impact because of the oil price collapse, and of course, significant demand impact coming from the coronavirus. In terms of how all of this specifically impacts the chemical industry, at a high level, we see three major factors. One is the broad economic collapse. In general, the chemical industry growth and demand is very strongly correlated to economic growth, GDP growth in particular. There's been a dramatic collapse in GDP outlook, and that's clearly going to have a pretty big impact on the chemical industry. A second big factor, especially for petrochemicals, is volatility around feedstocks. The oil market is today oversupplied, and as a result, and because of the demand impact coming from the lockdowns, we have seen a significant oversupply of oil-derived products and feedstocks as well. We also expect natural gas prices, which have been fairly low here, to rise in the medium term, primarily because a lot of the gas supply, especially in the US, comes from associated gas plays. And because oil production is going to fall, we expect associated gas production to fall and the overall supply growth in natural gas to decline. And collectively, that should have an impact in terms of gas prices rising. As gas prices rise, that poses challenges for the US chemical industry. We also expect significant volatility in ethane and NGL pricing. In general, we have seen a little bit of an uptick in ethane pricing. The general expectation is that ethane pricing will continue to increase in the US because of the decline in oil production and related production of NGLs. But if you look at global markets, LPG markets are significantly depressed right now. A lot of supply coming out of the Middle East of LPG has been impacted from a pricing point of view. And going forward, we expect some sort of these contradictory price patterns to have a pretty big impact on feedstock supply and pricing. In addition to these relatively obvious factors, there's another factor that's impacting the chemical industry, which is feedstock imbalances. If you look at the petrochemicals market, it is very intimately linked into the refining markets. A number of petrochemical plants are integrated with refineries, especially a lot of the newer capacity that has come up in the refining market has been these integrated refining petrochemical plants. And because of that, the impact on petrochemicals has been pretty severe from a feedstock imbalance point of view. Because of the log from the coronavirus, we have seen refinery utilization come down significantly because fuel demand has fallen significantly. And as a result, we see refineries operating at low utilization rates, and therefore the production of some of these feedstocks for petrochemicals has declined. And as a result, we see in some areas significant imbalances in some of these feedstocks, and this is going to have a pretty big impact on the overall petrochemical market. Going forward, we talked about this a little bit, but we expect NGL supply to fall, and this will potentially have an impact on pricing. Today, naphtha pricing is fairly attractive, and naphtha-based tracking is fairly advantaged. And the price, the margin differential, the margin premium that the US chemical industry enjoyed relative to, say, petrochemical assets in the Middle East or Asia, because of naphtha, which is predominantly reliant on naphtha. Some of that margin differential, that margin premium has gone away. But this doesn't mean that naphtha cracking is going to be, is advantaged in all ways. And one area where we see a pretty big impact from naphtha cracking is the co-products that come from a naphtha cracker. There's not enough, there are not enough markets there, and we expect some of these imbalances to significantly impact the overall petrochemical market. So taking a look at GDP outlook, the World Economic, the International Monetary Fund, in its January 2020 outlook, in the World Economic Outlook that it published in January 2020, had projected a 3.3% GDP growth for 2020. They just published a new economic outlook last month, and there they are projecting a contraction of 3% for the global economy because of COVID-19. So it's essentially a swing of a little over 6% in global economic outlook. Now, a contraction of 3% for 2020 compares to a contraction of minus 0.1% in 2009. So, in other words, another way to think of this is that the economic impacts from COVID-19 are 30 times larger than the economic impact that we saw during the global financial crisis 10 years back. And clearly, this is evident increasingly in the data that we see. This is data for the Association of American Railroads, and they are tracking chemicals traffic on the railroads. And the red line that you see there is data for 2020. As you can see, a significant collapse and a little bit of an uptick here in the last few weeks. And in comparison, you can see the level of activity that we have seen for 2018 and 2019. Collectively, on average, we estimate this impact to be close to 20% of the overall rail traffic that we typically see in chemical markets. Different companies are responding differently and are being impacted in different ways coming from this crisis. If you look, and we've represented some of them here, in general, most chemical players are seeing pretty big impact on sales volumes. So if you look at some of the larger players like BASF, Eastman, and Celanese, all of them have reported impacts of anywhere from 13 to 20% in sales volume. Now there are a couple of players that are advantaged. Dow has enjoyed a little bit of an uptick in sales volume, but more than that, if you look at further down in the value chain, Berry, Sealed Air, both of whom have a pretty big impact in polymer processing and markets downstream. Both of them have enjoyed, an uptick in sales volumes. Sealed Air, in particular, has seen significant growth in the need for packaging, driven primarily by a significant bump in e-commerce activity, as well as significant growth in the use of packaging for food products and other consumer applications. In addition to impacts on sales and volumes, we are reporting here some of the steps the chemical players are taking as they respond to this crisis. Clearly, capital spending is the first casualty for most of these companies. And you can see that some of the larger players like Shell, for example, have cut capital spending by as much as 50% in some of these segments. Even companies that have enjoyed very strong performance like Berry, for example, have resorted to capital cuts. And then, of course, we have a number of other players here, all of whom have collectively reduced capital spending across the different assets and across different projects that these companies are working on. Of course, what we anticipate going forward, all of these capital cuts will pose to capacity growth is a mixed bag. We clearly expect capacity growth to lag in certain places, but in some other segments, we expect capacity growth to come through other forms and not necessarily new capital projects. We have an example here of capacity additions for polypropylene in North America. If you look at the changes in the polypropylene market since 2018, what you'll see is that revamps accounted for almost twice as much of new capacity addition as compared to new projects. And in many ways, the increase in revamps was a little bit of a surprise and reflects how much flexibility operators have in adding new capacity and bringing new capacity online by just revamping existing assets. Going forward, we expect, because of the capex cuts, some of the new capacity and the new projects to be significantly constrained and likely canceled or delayed. But we expect that as the market goes through recovery, some of the better positioned operators will bring capacity increases primarily through the use of tools like revamps. So we do expect some new capacity to come on stream in the medium term, but it is going to primarily come through debottlenecking and revamp related expansions. Some chemical products are going to be significantly distressed. We have average butadiene pricing here. Butadiene finds a lot of applications in automotive markets. Tires is a good example. And as you can see, right, because of what we have seen over the last few years, there has been a significant decline in butadiene pricing because of the current situation. So butadiene is also a co-product that comes from naphtha cracking, and because the downstream markets for butadiene are not well positioned, are not seeing the demand necessary to invest in continued production, we see a significant oversupply of butadiene and therefore a significant reduction in prices. More strategically, if one thinks about some of the medium and longer term implications of some of these issues in the chemicals market, we see and think that the crude to chemicals projects should be advantaged going forward. In general, a lot of crude to chemicals projects don't suffer from these challenges in terms of reliance on refineries for feedstock for producing chemicals. And by essentially developing an independent supply chain where you're taking crude and directly cracking it to make chemical intermediates and feedstocks, and then eventually the petrochemical projects, we anticipate crude to chemicals and related projects to receive a lot of interest going forward. And clearly there are several projects out there already, but we expect renewed interest in this market in this particular area, just given some of the challenges that we see with integrated value chains in refining and chemicals at this point of time. Looking a little bit more deeply into polymer markets, in general, it's a challenging story out there. We clearly don't see any great opportunities from a growth or a performance point of view at this point of time. If you take a look at polyethylene, some of the demand has held up there, primarily led by food and other packaging needs. But in general, the market is fairly distressed, and some of the traditional advantages, as we discussed earlier, for ethane-based ethylene and therefore and eventually polyethylene, some of those advantages have disappeared, and we don't see a big premium that US-based production enjoys right now. More issues that we would need to keep an eye on are related to export markets. A lot of the US-based polyethylene capacity is targeted for exports. Given the fact that some of these COVID-related lockdowns are on a global basis, we expect some of these export markets to be distressed and potentially lead to oversupply in the market. Polypropylene is an even more difficult story. A significant chunk of polypropylene demand comes from the automobile industry, where there's a sharp decline right now. We expect this decline to translate into project cancellations. As I mentioned earlier, we've just finished a detailed in-depth assessment of the global polypropylene market, including some specialty grades. And we anticipate some of these markets to be impacted pretty significantly. PVC and vinyls, again, impacted quite significantly, given that they find applications in a number of construction applications. Clearly, construction activity has slowed down significantly. And again, similar to polyethylene, some of the cost advantage in North America is starting to decline. Finally, we see specialty polyolefin markets where we do a lot of work at ADI Chemical Market Resources. This is a mixed bag. This varies quite widely in terms of the outlook and prospects by segment. Some segments like adhesives, for example, have done very well, but a number of other segments have been impacted pretty significantly. With that, let me bring my colleagues into the conversation here, and we can talk a little bit about what some of the key questions are and what my colleagues are seeing as they work on a number of projects. We have a few questions here. Meanwhile, if you have questions, please put them in the chat box, and we'll be sure to address them in our conversation. Very quickly, Panusri, we'll start with you. What segments do you see benefiting due to COVID-19? We clearly talked about some segments that have been impacted, but are there segments that are benefiting in the current environment?
Okay, hi everyone. Yes, Uday, so talking about segments that are currently benefiting, we definitely know that personal protective equipment, other protective garments, those are the ones that are really looking a high uptick right now. Talking about other specialty chemicals like isopropanol, that has an application in the hand sanitizer and other applications for disinfectants. So those have seen a major uptick right now. And we were recently in touch with one of our clients who told us that anything that is remotely in relation to personal hygiene or disinfectant, those products are in a high demand right now. Even specialty applications such as food packaging and other need for packaged goods, since most of the people are staying at home, buying more packaged food items and other dairy products. So those have been really resilient in the current market. But if we talk about plastics and petrochemicals in general, we see that the market packaging has 38% of the share. We see that consumer goods have over 20% of share. Other PVC applications in construction is an 18% of the share, and automotive, they are also a pretty high share. And so when we look at these high growth, high market share segments, and then when we talk about the medical applications, which even after growing at this rate, they're going to constitute not more than 5% of the total demand that we've seen historically. So it's not a balance. They're not going to be able to, that uptick is not sustainable as we see. So that unsustainable growth is not going to be enough to offset the lack of demand that we've seen, the demand drop that we've seen in these other high market share applications. So
okay, so just so I understand, I think what you're saying is that although we are seeing an uptick in certain applications, whether they are around hand sanitizers, isopropanol, for example, or some of these markets, they collectively are a small fraction in terms of the overall demand for chemicals and petrochemicals. So even if it's a 10x growth, right, it's not significant enough to offset some of the impacts that we see, for example, from, let's say, polypropylene in automotive, where the automotive market has collapsed by, say, 30%, and polypropylene accounts for a significant chunk of that market. It's not good. The growth that we see in PPE, personal protective equipment, or some of these isopropanol markets is just not significant enough to offset that impact.
so yeah, it's exactly. So it's not a clear benefit, although they are growing.
Okay. Now, so we clearly talked about some of the companies that are suffering sales and volume reductions. We looked at how some of these companies are responding in terms of CapEx. But you've been spending some time looking at corporate performance in general, right, within the chemical industry. What are we seeing there? Are there some interesting trends or insights that we see from a corporate performance point of view in this current situation?
Yeah, so talking about since the last couple of years, we've seen that there has been increased interest and investments when it comes to integrating refinery operations and the petrochemical operations. And looking at the current situation, that model is not as advantageous as it used to be. And one of the highlights is one example that Shell talked about it in their recent earnings call, that when you integrate a refinery and petrochemical operations, and when you have an integrated plant, it's not very easy to say cut down production of one product and then keep the other products running, the high demand products running. So I think that's an interesting trend that we are seeing, that industry might think of shifting back to more specific modular plants as opposed to this integrations that we had been seeing in the last couple of years.
Okay. Utkarsh, let's talk a little bit about trade flows. I mean, we've been spending a lot of time looking at import-export data for a number of our number of polymer, polyolefin segments. I guess what's happening to trade flows in general? Can you share some high-level insights around that?
Hi everyone. Yeah, so post COVID-19, like before COVID-19, if we talk about the trade flows, like in 2019, North America and China were the biggest importers of polypropylene, and Middle East and Asia Pacific were the export regions. But post COVID-19, we expect the demand of polypropylene in North America to fall significantly, and in relation to that, it will import less PP than usual, less polypropylene than usual. So because of that, Middle East will be impacted significantly due to this. The local Middle East market in Turkey, that will also see a decline in demand and hence in general there will be a sharp increase in the inventory levels in Middle East. So apart from the auto and electronics market, other applications such as packaging, medical products, consumer products, they will be in demand. And China, being the largest importer and biggest consumer, will continue to import some volumes of PP. However, Middle East and Asia Pacific suppliers will face a tough competition in selling that high PP grade, and they will face some competitive prices. Talking about in general, however, there is a heavy reliance of global supply chains on China. And in the best of the circumstances also, there will be long lead times before Chinese and overseas imports are working normally. So there will be a significant impact of trade flows, and basically Middle East and other export-oriented regions will suffer the most.
So I think it's interesting, right? Because I think if you look at the extent of these lockdowns and all that, right, it does not seem to have impacted the Middle East as much, for example. But it seems like they'll still probably feel some of the pain associated with the broader, I guess, decline in economic activity, mainly because they are an advantaged exporter to a lot of these markets. So it's interesting that everybody collectively is going to feel quite a bit of pain coming out of this this situation. So thinking about coming out of this situation, how should we think about recovery in chemicals and petrochemicals? We are increasingly working on that question as that comes in from clients, and they are asking us questions like, okay, let's think about recovery now. Which regions are going to recover first? Why? Where should we be focusing our time and attention on? So, broadly at a high level, how should we think about recovery in the chemical and petrochemical markets?
Yeah. So talking about the chemical and petrochemical industry, there are a lot of things that will impact the recovery in petrochemicals. And that is directly related to the type of plastics the producers are producing. So recovery in plastic markets will mean in general that these three key things are happening in the market. And these three things will be, first of all, producers are ramping up their production capacities to the normal operating levels, that is like 85 to 90%. There is a bounce back in daily consumption of products made from polyethylene, polypropylene from recent disruptions to global manufacturing supply chains. So like, as I said, that the supply chains have to be normalized. And the third key factor, what we think is that the demand for polypropylene and polypropylene in the auto sector, primarily in the auto sector, has to climb, as most of the high grade, high premium products for these specific grades are used in this sector. So since the margins will be less, since the demand for the auto sector will suffer, so there has to be a uprise in the auto demand, which is highly unlikely in the coming months. If we look into the PP market and polypropylene market in China, so we think that due to low feedstock costs, operators will ramp up their capacities to produce more downstream products, and they are doing that. But this will give rise to the inventory levels. But as the economy opens up, we expect the levels to normalize by end of the year. And the primary reason is that there are very few capacity additions that will come up because of COVID-19. And due to the decrease in capex by a lot of companies, they will prefer to have more revamps and they will delay their new capacity additions that are coming up in China and other regions. For example, in China, there is a company called Tianjin Bohai Chemical that has recently announced that they are delaying the startup of the new polypropylene plant until next year. So the recovery will happen, but there are a lot of factors that are involved in that.
Okay. So I think what I'm hearing is that I think the recovery is not going to be a nice linear path, but it is going to be choppy, volatile, and a lot of that depends on how some of these large end-use markets like automobiles and all that perform. And if there is an economic recession, then some of these market segments are not going to perform as well. So I think it's worthwhile to start thinking about recovery, but I think with the expectation that this is going to be a long journey here.
Yeah.
A last point, and I've been spending some time around this, is around sustainability and recycling, right? I mean, clearly, I think this crisis has reinforced to a lot of people the value that plastics bring to society in general. And this comes off the back of the last couple of years when there's been growing scrutiny around the use of plastics and their environmental footprint, and how to make some of these markets. And there's been growing consumer pressure, right, to make some of these market segments, some of these markets more sustainable. We clearly anticipate some of these pressures to continue, though. I think there's clearly a greater recognition and awareness, and because of hygiene, I think some of the single-use plastics will continue. to grow, and in a lot of emerging economies, right? The penetration of single-use plastics is not as high as it's in, let's say, Europe or US. And I think some of these, some of these markets will continue to see the growth of single-use plastics. So it is possible that some of these sustainability and related conversation might potentially but we don't anticipate it going away, primarily because there's a lot of consumer support around this. And so even if there's probably some sort of a slowdown, we anticipate some of these issues to continue to stay important going forward. A couple of questions that came up through the chat box. One of them is on the outlook for propane dehydrogenation projects, especially grassroots projects. I think in general, we expect all grassroots projects to be delayed in the current environment. I think it will be pretty brave of someone to kind of to consider any grassroots project at this point or time, unless there's greater clarity, greater certainty. I don't think we anticipate a lot of activity there. A second question that came up focuses on what happens to the petrochemical industry because of the declines that we see in oil production and petroleum production. So we talked about this a little bit earlier, but in general, we expect, because of lower oil production, lower associated gas production, and therefore potentially higher gas prices, that's going to have an impact, negative impact on the petrochemical industry. We expect NGL prices, ethane prices in particular, to rise. We don't anticipate ethane shortages of any kind, primarily because there's plenty of ethane, and plenty of ethane is being rejected. But I think collectively we anticipate some sort of a pricing uptick in feedstocks for the petrochemical industry because of the declining oil production in the US. So with that, let's wrap up our conversation today. Again, if there's interest, please reach out to us for our new report on helping clients navigate the perfect storm. We can share more information if this is of interest. Join us next Thursday at 11 a.m. Central again for a webinar on another topic. This time we'll talk about power and utilities markets. You can sign up for this at our website, adi-analytics.com. With that, thank you for joining us again today. We appreciate your support. Look forward to seeing you next week. Have a good rest of the week.